Investing can feel like a maze sometimes. SIP, Lumpsum, SWP, what do all these things mean and how do you choose the right one? Let me break it down for you. When you plant seeds and water them every day, that is SIP. When you plant a big tree, when the soil is fertile, that is Lumpsum. And finally, after a few years, when your plant has given those fruits and it is time to enjoy, that is called SWP. Sounds interesting? Let's dive in. I've been investing for over 10 years now and I've done thousands of mistakes. One of them, not knowing when to do SIP, when to do Lumpsum and when to do SWP. And over the past 1 year, I have done almost 100 portfolio reviews from my viewers and each one of them was confused when to do what. Some people felt SIP is the only way to build wealth. Some people would just panic when the market crashes and would wonder if they should invest more or should not. And finally, the third set, who would just sell everything when the market crashes. Today, I'm gonna clear every single doubt of yours and would exactly tell you when to do SIP, when to do Lumpsum and when to do SWP. Let's begin. Let's start with SIP. What exactly is it? SIP is Systematic Investment Plan. It basically means investing a fixed amount regularly. Generally, people do it monthly into stocks or mutual funds. It is like reverse EMI because in EMI you pay a fixed amount to the bank, but in SIP you pay a fixed amount and you invest it in stocks or mutual funds. Now, how does it work? It works because of a concept called as rupee cost averaging. And let me explain it to you with an example. Imagine you want to buy chocolates every single month. Now, you want to spend 100 rupees every month to buy chocolates. Now, let's say the chocolate costs rupees 100 this month. How many chocolates can you buy this month? You want to invest 100 rupees. One chocolate costs rupees 100. So now you will buy only one chocolate this month. Now, next month, let's say the cost drops and this chocolate is costing 50 rupees. How many will you buy? This time you will buy 2 chocolates. And let's say next month the cost drops even further. This chocolate costs rupees 25. How many will you buy? You will buy 4 chocolates now. And then suddenly in the 4th month, the cost just doubles and becomes 200. Now how many can you buy? You can buy only 0.5 chocolate. Do you understand what I am trying to tell you? It basically is when the cost is more, you are buying less. And when the cost is less, you are buying more. This basically means your average cost has come down. And this is why over a long term, your average cost will be somewhere here and the Nifty or any other index would be here. And this is how you make profit when you do SIP. And the best part here is it creates a discipline in your life. And that is the most important thing. When the market is at the peak, you will invest. When the market crashes, you will invest. When the market goes sideways, you will invest. Because you're investing on, let's say, 1st of every month, irrespective of where the market is. And that's the most beautiful part about SIP. You don't have to think about when to start, when to end. Just keep it running all the time. It is the most ideal for salaried people. You receive, let's say, 1 lakh salary, allocate some part in SIP and keep it running for longer term. If I give you an example, imagine you have, let's say, 1 lakh salary and you want to invest 15,000 every single month in any mutual fund. And you run it for like 15 years. So if you invest 15,000 every month, you basically are investing 1,80,000 every year. Over a period of 15 years, you would have invested 27 lakhs. And now suppose your mutual fund has given you 15% return. What will be your final return? What do you think? It will be 1 crore. And that is the power of compounding and discipline. You have just invested 27 lakhs, but the overall return is now finally 1 CR. This is why discipline is the most important thing in investing. Please follow it. Now let's understand what is Lumpsum. Lumpsum basically is a one-time investment when you have a lot of money at hand. For example, in our previous example, we said we have a 1 lakh rupee salary and we are investing 10,000 every single month. Now let's say suddenly in the month of December, you receive bonus from your company and you receive 5 lakhs. What would you do? Or imagine you have sold your property and you receive 10 lakhs. What will you do? Please do not put this in FD. It will barely give you anything. And now this one whole big chunk of money you have to invest, and this is called lump sum. A one-time investment into stock or a mutual fund anywhere. And how does this work? So understand this. Over time, the market always goes up. And it is the best time when the market crashes. If you put a lot of money, if you put money in lump sum, that will grow the most. And if you don't understand this, watch this chart. This is a chart of Nifty from January 2000 to January 2025 in the last 25 years. And you would see a lot of crashes, a lot of times when the Nifty is going down. See, this is time when Nifty was going down, then here it was going down. But if you look at the bigger picture, over a long term, Nifty always goes up, or the market always goes up. To be honest, for the next 15 to 20 years, I believe at least the Indian market will go up. So do not panic when the market crashes. Do not look at the short-term horizon. If you look at a longer-term horizon, the market will always go up, which basically means when the market crashes, it is a great opportunity to invest a lot of money in it, which is basically a lump sum investment. But very important, when you put lump sum amount of money, do not put it in penny stocks or some very risky stocks. Generally, I invest lump sum money in Nifty. Nifty is the safest form of investment. It is the top 50 companies of India. If you put money there, generally it is very safe. So when the market crashes, and this reminds me, today when I'm shooting this video on Jan 6th, the market has crashed like by 2%. So Nifty from 26,000 has come to like 23,500. A great time to invest in lump sum if you have money, but do your research before doing that. I am not recommending it. I am doing it, yes. So this is the power of lump sum. It is ideal for people who receive a lot of money suddenly and they have to invest it. I hope you understand this. And finally, we have SWP, Systematic Withdrawal Plan. And this is exactly what brings us closer to financial freedom. See, we all have to die one day, and there's no point investing all our life. We should spend some time enjoying life as well. And that is where SWP comes into the picture. If you're investing all your life and you never withdraw that amount, what's the point? And that is why you should always have a plan of withdrawing as well. Now, let me explain it to you with an example. Let's say you invest all your life, and let's say you want to retire at 50. I won't take 60 because it makes zero sense to retire at 60. At least retire in 50, if not in 30s or 40s. Now let's say you invest all your life, and finally when you're 50, your total investment amount is 2 crores. And this is locked in some mutual fund. And this mutual fund gives you 12% return. Now if you want to start SWP, and let's say you say I want to withdraw 50,000 every single month to support my lifestyle, which basically means over a period of 1 year, you will withdraw 6 lakh rupees. And now your initial corpus is 2 crore, which is giving you 12% every single year. So the return from this mutual fund will be around 24 lakhs, 12% of 2 crores. Now out of 24 lakhs, you have spent 6 lakhs. So you still have saved 18 lakhs more. And if you keep doing it for the next 10 years, from 50 till 60, so if you withdraw 6 lakh every single year, in the next 10 years, you will withdraw 60 lakhs. What do you think will be the amount when you will be at 60? Guess a number. It will be 5.16 crores. Yes, even after withdrawing 60 lakhs, you will have 5.16 crores. And this is how you achieve financial freedom. When you know how much you can withdraw from your corpus. Generally, to make it infinite, your withdrawal rate should be less than 4-5%. In this case, we have a withdrawal rate of 3%, which is the most ideal. So if your withdrawal rate is less than 4-5% and your mutual fund is or anything is growing by 10-12%, basically you have infinite amount of money. You can retire, you can spend the remaining life enjoying. And that's the idea of having life, right? To enjoy at least sometimes. And this is how you should plan SIPs, lump sum, and eventually SWPs to enjoy life and also to invest. I hope this clarifies a lot of questions that you had. So what is the conclusion? SIP, SWP, lump sum are all tools in your investment toolbox. SIP is for disciplined long-term investors. Lump sum is for those bold people who want to seize the opportunities. Finally, SWP is for the people who want to enjoy the fruits of their labor. The key is to understand when to use what. And now you do. If this video gave you clarity, give it a thumbs up. Share it with someone who is still confused when to do SIP, when to do lump sum, when to do SWP. And finally, before you go, please watch this video. This will help you pick the best mutual fund for your portfolio so that you can finally achieve financial independence and you can start your SWP. Until then, keep investing. Thank you.